Brad Williams, Frugal Finance. Here's an example by Demoterin. You can modify it as you want. This is valuing the short-term option with dividend adjustments. This program calculates the value of short-term options less than 1 year, adjusting for dividends by subtracting the present value of expected dividends from the current value of the asset. The assumption, all the assumptions underlying the Black-Scholes model apply. The amount of the dividend and the ex-dividend date are known. The user has to input the following variables: current market value of the underlying asset, variance in the log normal value of the underlying asset, strike price, the riskless interest rate that corresponds to the life of the option, time to expiration and expected dividends, and date of ex-dividend payments. Inputs relating to the underlying asset: enter the market value of the underlying asset, enter the standard deviation, and are any dividends expected during the option lifetime. That would be the method for calculating the short-term option. How to use goal seek? That's what we're going to do. We're going to use goal seek here. Change market value to any number, G19. Copy paste call price to fixed number for references only in cell D57. 57 right here. Use goal seek to find market value G19. G19 right here. T11250. Set cell to call price D53. The value call price by changing cell market value G19. Implied volatility. Change standard deviation to any number G21. Here we have G21 right here. Copy paste call price to fixed number for references in cell D57. Use goal seek to find implied volatility. Set cell to call price D53, the value call price by changing cell standard deviation G21. You can go through, change up the numbers from the previous example if you want. Why don't we look at the example shown in the previous lesson? Here we have, considering the following example of an implied standard deviation based on a call option, we assume that X equals 100. That would be the current market price of the underlying asset. Option is at the money so that the strike price equals 100. We also assume that the option has 90 days remaining until expiration and that the risk-free rate is 10%. So we have T minus T equals 90 days. And R is equal to 0.10, and the call price is $5. So why don't we look at this model here, and we can solve for implied volatility if we make a few changes. Right now we have this 125 with the standard deviation. So why don't we just go through and I'll show you what's going on here. If you haven't used goal seek before in Excel, you go up to what if analysis under data. So you go data, what if analysis, and goal seek. That's it. You're going, well, what's this supposed to do? Well, you just follow these steps. We're looking at set cell G19. It says use goal seek to find implied volatility. This is if you want to change the standard deviation. Set cell to D53. We're going to point to D53. And then we're going to go to a value, which is, now we have a stock price. Why don't we just say $20? So you have to hard code this. $20 by changing cell standard deviation G21. To change this, our requirements are, we need to change this stock price and its strike price. No dividend. Our time to expiration is 90, and then our risk-free rate, it looks like it's at 10. You can see here, we have a 105 stock and a 105 strike price, same parameters, and we have 15% volatility. Ours is a $100 strike price, a value of $5, that's given. Everything else is the same, 90 days, strike price. So we go 100. We're going to change that using this what if analysis, goal seek. Then we need to change this. And this number here is what we're going to manipulate. That being said, we're going to go what if analysis, goal seek, and then it says set cell, and it says set cell to D53, 445. The value, we're setting it to 5 because that is the value of the call, and we're going to change the volatility. That's what we're looking for. And make sure there's a formula in D53. If not, it won't work. And in terms of some other requirements within Excel. I'll just show you. Okay, I'm going to hit OK. And then within a blank, it came up with volatility of 1904, which is different from the 18.8. I'm thinking this is probably more accurate. So we got volatility of 1904. So just go with it, all right? When you're working with goal seek, do you have this iteration? In other words, how many times will this thing compute over and over and over? Well, the default is 100. And if you start playing around with this thing and you get a little bit out of whack, in other words, you always want, here's a suggestion. If you want to change this underlying 105, let's say you want to change this to 120 and everything else stays the same, you want to get volatility. Well, I strongly suggest you hit F9. You want to make sure your price here, value of the call, is close. So when you go into goal seek, it says goal seek and it says to value. Make sure it's close, otherwise it won't work. With that being said, we'll go D53. We're going to change it to 22. Why? I'll go to 2150. 2150 as an example. 2150. We're just going to change G21. And let's see if this will work. You can see it's doing all its iterations. I set it to 2000, but the default is 1000. And this is how volatile this thing is. It is, maybe it's not the best tool. It's a good starting point. It doesn't do a really good job if you try to stretch it. My suggestion is just be patient. It's running. Here are the iterations. Okay, it's trying to solve this thing. It just doesn't do a real good job unless you're really close. So 2150, it just can't manipulate the numbers. It's not the most powerful algorithm out there. So here we are at 1450. It should have solved it in a beat. The target value has got to be really close for this to work. In other words, we knew it was 2232 or something like that. We tried to change the volatility on a different price, and it didn't work. And it ran out of iterations. So what you have to do is go in and cancel. Go to goal seek. What if analysis, goal seek, and then we're going to go back to 53, and we're going to make this 2225. And we're going to change this. We're going to change this to this number here. Let's see if it works. I don't know. Oh, the other thing here, notice how weak this thing is. Because the strike price is $20 difference from the stock price, you can see right off the bat, you're going to have at least 20 bucks in strike for this thing to make any sense. We're saying within 90 days, this price is going to be higher. What am I talking about? 2232. But we already have a $20 difference. And again, this model is not that good. So now if I go 120, here, I got to cancel it out of here. 120. We know it's 2237, but what if we try to get a price of 23? What would the volatility be? We'll go back to goal seek, change 53. Oh, now we're going to be a little bit different. Here, hit F9. Why? Because we have 90 days, we're in the money, so the time premium is $6. We don't know what this volatility is. That's what we're trying to solve for. But we have a $6 premium. So what if we go 625? What's the volatility of this thing at 120? We can go goal seek 53, $6, $6 by changing volatility. And again, now it's saying 1904 again. Let's try this again. F9 and 120. Value of the call. What if goal seek 53, 625? And by changing the volatility. All right. So it did change it to 20.14. Any real miracle here? No. But at least you now know you can change the volatility using goal seek. Be close. In other words, be sensible in terms of the power of this thing. It's not very powerful. Clearly, if there's a huge variation between stock and strike price, it just doesn't perform very well. That being said, it's a tool. Probably more tools online. They may cost you something. This is free. So use it. You can go online. I suspect there are models out there, but they're going to charge you. Brad Williams, Frugal Finance. Thanks for watching.